The Precious Metals Week in Review, April 29, 2016. Brought to you by Precious Metals International. Central banks seem to be the primary driving force for market movements this week, as both the Federal Reserve and the Bank of Japan concluded their monetary policy meetings by taking no action this week. The number of Americans filing initial claims for state unemployment benefits surged higher last week, climbing by 9,000 claims to a new seasonally adjusted level of 257,000 for the week ending April 23rd. Claims for the previous week were also revised higher to add 1,000 more claims than previously reported. The U.S. Federal Reserve held its Federal Open Market Committee (FOMC) meeting to determine monetary policy this week and opted to leave rates unchanged again. In a statement following the FOMC meeting, the Fed said, "Economic activity appears to have slowed. Growth in household spending has moderated, although households' real income has risen at a solid rate and consumer sentiment remains high." On Friday, data from the Commerce Department showed that U.S. inflation barely rose in March, strengthening the view that the economy is underperforming and that the Fed will now be much more likely to only conduct one rate hike, if they can even conduct any at all this year. In its advanced estimate of U.S. economic gross domestic product (GDP), the U.S. Labor Department said that economic growth had slowed, increasing at a meager rate of 0.5% annually, which is the slowest pace since the first quarter of 2014. Cheaper oil, weak consumer spending, and a stronger U.S. dollar that continue to impact exports all acted in concert to put the brakes on U.S. economic growth in the first quarter. The Bank of Japan, BOJ, shocked the financial world this week when it announced that it had chosen to keep its monetary policy unchanged on Thursday. The BOJ was widely expected to announce additional stimulus measures this week, as the bank continues to struggle to reach its stated inflation target of 2%. Despite taking no action at all, BOJ Governor Haruhiko Kuroda, speaking at a press conference at the conclusion of this week's meeting, told reporters that the BOJ was committed to hitting its inflation target within 2 years. Mr. Kuroda also said that the BOJ still had stimulus options available to it, including cutting rates further into negative territory, and that the impact of negative rates thus far has been small to bank earnings. Also in Japan on Thursday, inflation data released just ahead of the BOJ's announcement that it would not undertake additional stimulus showed that Japanese consumer prices fell at their fastest rate in 3 years in March, and household spending also plunged, falling at its fastest pace in a year. Lower oil prices seem to be the major factor in the declines, as consumers and businesses alike spent less on fuel but did not turn around and put the extra savings back into the economy through spending. Plunging inflation data might lead the BOJ to consider implementing additional stimulus programs when it next meets to determine monetary policy moves. The worse-than-expected data also led to wide criticism of the BOJ's inaction at its latest monetary policy meeting. The International Monetary Fund (IMF) posted what seems to be a warning regarding China's growing debt load in an online blog on Tuesday. China's debt has been skyrocketing as their economy has continued to slow, with the IMF estimating that corporate debt levels in China are at 160% of their GDP. James Daniel, Jose Garrido, and Marina Moretti, all of them from the IMF, wrote a blog post on Tuesday saying China's corporate debt load is very high compared to other, especially developing countries. Going on to discuss rumors of recent proposals by the People's Bank of China that would allow banks to exchange non-performing loans for stakes in companies, as well as a recent grant that would allow some large domestic Chinese banks to issue asset-backed securities that contain non-performing loans as part of their assets, the group said, "While such techniques can play a role in addressing these problems and have been used successfully by other countries, they are not comprehensive solutions by themselves. Unless they are carefully designed and part of a sound overall framework, they could actually worsen the problem, for example, by allowing zombie firms to keep going." In Europe, serial bailout offender Greece is back in the headlines again. On Wednesday, Greece accused the International Monetary Fund (IMF) of undermining its efforts to negotiate its funding options after talks over unlocking additional funds from its third bailout hit a rock bottom. A meeting to discuss Greece's progress in its latest bailout that was supposed to take place on Thursday was canceled due to lack of progress in identifying the necessary Greek government reform actions. The lack of progress appears to be due to a request made last Friday by its lenders asking for a contingency plan that would see automatic spending cuts and other measures kick in if Athens fails to meet its assigned fiscal targets by 2018. The lenders want the measures to be enacted via legislation, and Athens has said that it cannot pass legislation on hypothetical events and has thus far refused the proposal. Eurozone finance ministers are now set to meet on May 9th to discuss options for Greece. Crude oil continued to defy fundamentals, climbing into the upper $40 a barrel range despite continued fallout from last week's failure to come to agreement on a production freeze between OPEC and other oil-producing nations in order to help stabilize prices. A weakening dollar after the Fed's decision not to raise rates and further declines in U.S. oil production aided in boosting prices despite an expected rise in output from the Middle East in the near future. The euro climbed steadily against the U.S. dollar all week and will close the week there. The Japanese yen drifted mostly sideways against the U.S. dollar until Thursday morning. Following the Bank of Japan's failure to take further stimulus action, the yen saw an immediate vertical leap to the upside and then began steadily rising against the dollar through Friday. The yen will also close the week higher against the U.S. dollar. Central banks around the globe seem to all be content to wait until June, if not later, before they conduct any further monetary policy changes. The U.S. Federal Reserve held its rates steady this week, following on with the European Central Bank's move to do the same last week, and the Bank of Japan followed suit on Thursday, choosing inaction over implementing further stimulus. In June, the United Kingdom will hold its referendum on whether it will remain as part of the European Union or strike out on its own. The date of the referendum is June 23rd, which is just over 1 week after the U.S. Federal Reserve's next Federal Open Market Committee meeting to set monetary policy, occurring on June 14th and 15th. If economic data for the U.S. has not improved significantly in the intervening time, it is highly unlikely that the Fed will make a move to raise rates further ahead of the Brexit vote due to further global uncertainty, which means that the next likely time frame for the Fed to raise rates would shift to September. A massive data dump out of the Eurozone this week also showed that the region had moved back into deflation again, with consumer prices falling 0.2% in April, down from an unchanged level in March. The European Central Bank, ECB, has been under increasing fire of late, particularly from Germany, for the lack of results from its stimulus efforts. ECB President Mario Draghi fired back at the criticism over the central bank's policies, saying, "Our policy is working, but we must be patient. Investor confidence has not yet been fully restored. Meanwhile, Euro area countries are now able to buy more German exports again, which for German companies is partly making up for the decline in trade with China. But it is a slow process because the crisis was more severe than anything we'd had since the Second World War." Germany's main complaint is that the negative or zero interest rate policies that the ECB and the world's major central banks are all engaging in is doing nothing more than punishing those who are diligently working to try to save their money, while at the same time rewarding the risk takers who are simply taking on even more debt amid an environment of low interest rates. It turns out that even as it keeps hinting at needing to raise rates, the U.S. Federal Reserve will be requiring banks to plan for negative interest rate policy when they conduct their annual stress tests this year. Banks, faced with growing consumer deposits as people choose to save their money instead of spending it, had been expected to pass on any impact of negative rates to their corporate and commercial clients while leaving consumer deposits untouched. The problem with this philosophy is that these same banks' corporate and commercial account bases appear to be shrinking, even as consumer deposits are on the rise. If this trend continues and the Fed chooses to implement negative rates as other central banks around the world have done, these banks will have a hard time keeping consumer deposits isolated and could be forced to pass on those negative rates to the customers themselves. One bank advisor, speaking to CNBC on condition of anonymity, said that the fact that consumer deposits were outpacing commercial and corporate deposits was a surprise, and that some possibilities for applying negative rates to consumers would be outright charging consumers for holding their money at the bank or keeping mortgage rates elevated despite pressure from the Fed to lower mortgage rates in a negative interest environment. So, as global central banks all seem to enter wait-and-see mode prior to the UK referendum in June, we expect further market volatility in stocks, particularly if China's economy also shows signs of continued distress as their debt loads increase. In the globally interconnected economic environment, wise investors continue to include precious metals as part of a well-diversified investment portfolio, recognizing that unexpected events transpiring outside of the U.S. can easily trigger a sudden and rapid decline in stocks. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, April 29, 2016. Brought to you by Precious Metals International.